This isn't a normal gold move. This is the kind where the physical supply chain quietly vetoes the paper market, and the people quoting spot get forced to explain why the metal won't actually show up. The conflict is already here. Headlines tell you the price is high but stable, while the people who actually source and ship physical are suddenly rationing, widening spreads, or flat out refusing to lock in delivery. And the hidden detail the mainstream keeps missing is brutally simple. In gold, it's not how much exists. It's how much is deliverable on the schedule the market is demanding, under the collateral rules the market is enforcing. Stay with me, because by the end, you'll have a concrete next 2-week checklist, the levels that matter, what confirms a real squeeze versus a fake out, and the one pressure gauge that tells you whether this wholesale freeze is a passing hiccup, or the early stage of a $150 panic becoming a much bigger repricing. And that's where the real pressure starts. Because when you see a $150 premium pop up on everyday physical product, coins, small bars, the stuff normal buyers actually touch, that's not just dealers being greedy. That's a stress signal. It's the market admitting, out loud, that the headline price is no longer the full price. You're paying an additional tax for immediacy, certainty, and the right form factor. And the moment that premium appears, you are watching the supply chain do something very rational and very scary at the same time. It asks pricing the risk of being short optionality. Not short gold in theory, short delivery in practice. That distinction is everything, but that's not the part that matters yet. The part that matters is why wholesalers freeze first. Because wholesalers sit at the most fragile point of the chain. They are the bridge between I can hedge this on a screen and I can ship this through the real world. When volatility rises, that bridge starts to shake and the people standing on it tighten the rules immediately. Short sentences now. It happens fast. Quotes vanish, allocations get cut. Call for availability. Lead time extended. That's the freeze. And if you're only watching the chart, it looks like nothing. If you're watching the plumbing, it looks like the beginning of a squeeze. Now put the price context down on the table, because it changes the entire psychology. Gold is not waking up from a nap. It's been running hot for a while, and early January 2026 has it trading in the mid-4,000s, with recent highs pressing into the mid-4,500s. That matters because at these levels, everything gets more expensive. Inventory financing, insurance, hedging margin, even simple working capital. The same dealer who could sit on a couple $1 million of product at a lower price now has to justify a much larger balance sheet footprint to hold the same ounces. And the higher the nominal price, the more violently the collateral system reacts to daily moves. So even if the underlying trend is bullish, the path becomes jagged. Liquidity thins, spreads widen, and the weak hands get harvested. Because if this one level breaks, the math changes. Here, almost the first truth that separates people who understand this market from people who just repeat narratives. Spot is a headline number, physical is a calendar, a balance sheet, and a truck that has to show up. Spot is where a lot of opinions fight. Delivered metal is where constraints win. And constraints don't care how confident someone sounds on television. They care about form, location, timing, credit lines, and collateral rules. That's why you can see a calm chart and a panicked physical market at the same time. That divergence is not a conspiracy. It's market structure. And the next detail is what flips the whole setup. Most people misread inventory in gold. They see a big number and assume abundance. But in the real plumbing, inventory is not one thing. There's metal that exists, metal that's stored, metal that's pledged, metal that's earmarked, metal that's eligible but not offered, and metal that is actually deliverable on the terms of a specific contract in a specific window without triggering a cascade of balance sheet stress. If you're not separating those categories, you're reading the market with the wrong instrument, and that's where the hidden mechanism lives. Deliverability, the float, the metal that can move without someone else having to unwind a hedge, post more margin, or break an allocation promise. And once that deliverable float gets tight, premiums can explode even if the headline pile looks fine. That's how you get a retail premium shock while commentators laugh and say, there's plenty of gold. Plenty where? In what form? Under what rules? On what schedule? Those are not rhetorical questions. Those are the questions that decide whether the wholesale market keeps quoting tight spreads or freezes. Now let's talk about why suppliers would refuse to ship, because that sounds insane until you realize what they're protecting. A wholesaler is effectively running a book. They buy metal, sell metal, and hedge price risk, often with futures, forwards, or OTC swaps. In a quiet market, that's manageable. In a violent market, the hedge becomes the problem. Not because hedging is bad, but because the collateral demands of hedging rise exactly when volatility rises, exactly when liquidity thins, exactly when everyone is trying to de-risk. That one's the forced buying engine in so many sudden moves, and it's not emotion, it's math. Picture this. A wholesaler sells product today for delivery next week. They hedge by selling futures or entering a forward. If the price jumps, their short hedge bleeds mark to market, and they have to post more collateral immediately. Cash out the door. Now add the real world. They still have to pay for shipping, insurance, fabrication, and inventory carry. If their credit line is capped or their risk department tightens limits, they don't have the freedom to keep quoting tight. They have two choices: widen the spread massively to compensate for collateral risk, or stop quoting. And when enough players make that same rational decision at once, it looks like a freeze, but it's just de-risking under stress. And that's where the real pressure starts. Because the freeze doesn't happen at the top of the chain first. It happens at the narrow points, where balance sheets, margin rules, and delivery timelines intersect. Now let AS pull the camera back and look at the market structure signals that tend to leak the truth before the headlines catch up. One is the term structure, how futures prices compare to spot across different maturities. In a normal carry market, you often see futures trade above spot by an amount that roughly reflects financing and storage costs. That's contango. When the market starts paying up for immediate metal, you can see the structure flatten or flip. You can see stress appear in spreads, those quiet little differences between nearby and deferred contracts that most retail traders never look at. And spreads don't lie the way narratives do. If nearby demand intensifies, if people want metal now, if rolling positions becomes costly, the spread starts screaming. Sometimes it's subtle, sometimes it's a siren. Either way, it's a signal. And if the spread behavior gets aggressive into a delivery window, you're not watching sentiment, you're watching a timeline problem. Because in a futures market, time is a weapon. As delivery approaches, paper promises have to reconcile with physical realities or be rolled, offset, or cashed out. That reconciliation is where stress can turn into reflexivity. Now add the global layer, because this is where the story gets cleaner. If you want to detect physical stress without drowning in noise, stop staring only at one benchmark and watch regional premiums, especially in Asia. China's premium behavior, in particular, often acts like a pressure gauge because of how demand, policy, and local market structure interact. When China trades at a meaningful premium to international benchmarks, it's not just a number, it's a pull signal. It's telling you metal is valued more there than here. That creates an arbitrage incentive. Metal wants to migrate toward the higher priced region. But, and this is the point people miss, arbitrage is not instantaneous in gold. It's slowed by logistics, by refinery constraints, by bar specifications, by vaulting rules, by paperwork, and by the simple fact that gold is not a single fungible blob in every channel. The wrong form in the wrong place at the wrong time can feel like a shortage even when there is metal elsewhere. That is how you get the wholesale freeze. And it is not that gold ceased to exist, it's that the path from where it is to where it needs to be has friction, and friction gets brutal when volatility spikes. But that's not the part that matters most. The part that matters is what wholesalers are protecting themselves from, getting trapped between a retail panic bid and a wholesale hedge that S demanding more cash every day. Now let's stack proof, because one argument is never enough in markets like this. Proof point one is the premium itself. A $150 premium is not a rounding error. On a 1 ounce product, that can be a few percentage points on top of an already elevated price. That kind of premium says demand for immediate retail-friendly metal is colliding with limited short-term supply in that exact category. Proof point two is lead times and rationing behavior, when dealers move from in stock to allocated, when wholesalers require larger minimum orders, when they change terms mid-quote, when they stop honoring tight spreads. Those are on-the-ground symptoms, and they show up before any official report. Proof point three is the spread and curve behavior, when nearby tightens relative to deferred, when rolling costs change, when the convenience of immediate access is suddenly priced. Proof point four is cross-market comparison, when premiums diverge across regions, especially when one region's premium stays elevated longer than expected, suggesting the pull is persistent, not a one-day fluke. Proof point five is institutional behavior, the way big pools of capital talk and act around levels. When major institutions publish aggressive forecasts, numbers like $4,800 or $5,000, most people hear a prediction, desks hear a positioning risk. Because bullish narratives attract trend followers, and trend followers create one-way flows, and one-way flows tighten liquidity. Then hedgers pay more to hedge, dealers widen more to protect themselves, and the whole chain becomes more brittle. That doesn't mean forecasts cause the move. It means forecasts can amplify a move that is already being driven by structural pressure. Proof point six is central bank demand dynamics. Central bank buying isn't about day-to-day emotion. It's about reserves, diversification, and long-term positioning in a world where currency confidence is a variable, not a constant. When that bid is present, it changes the floor. It removes float from the market in a way that doesn't quickly come back when price dips. That's important because squeezes don't require the entire market to be tight. They require the marginal supply to be constrained when marginal demand refuses to back off. And that's where the real pressure starts. Now I want to make the paper versus physical mechanism crystal clear without turning this into a lecture. Paper markets, futures, forwards, swaps, are incredibly efficient at discovering a price for risk. They are not always efficient at guaranteeing immediate delivery of a specific form of metal to a specific buyer under stress. Physical markets are messy. They have bottlenecks. They have lead times. They have credit terms. They have operational risk. In calm periods, paper and physical converge neatly because arbitrage keeps them aligned. In stressed periods, that alignment can loosen, and the looseness shows up as premiums, spreads, and availability problems. That is not a violation of finance. That is finance in its most honest form. Risk is being priced. Constraints are being priced. And if constraints persist into key calendar windows, the paper price can be forced to reprice higher to ration demand or incentivize supply. But that's not the part that matters yet, because the why now is the calendar. The calendar is the catalyst that turns tightness into action. Early year liquidity can be thinner. Month-end and quarter-end positioning pressures can force funds to rebalance. Options expiry can create a hedging feedback loop where dealers who are short options have to hedge more aggressively as price rises, which can mechanically add buying pressure. Delivery windows matter because they create deadlines. Either positions roll, get offset, or face delivery mechanics. And when deadlines arrive in a market with elevated volatility and a fragile supply chain, behavior changes fast. This week and this month, the market is not only digesting a high nominal price, it's digesting the collateral cost of that price. That is a silent tax. And silent taxes create freezes before they create headlines. So what does this force participants to do? It forces wholesalers to protect capital by widening premiums or reducing commitments. It forces dealers to hold less inventory because inventory is expensive to finance when volatility is high. It forces hedgers to post more margin, which can create forced selling elsewhere to raise cash, sometimes even selling gold temporarily to meet collateral needs, which creates violent whipsaws even in bullish regimes. And it forces buyers to either accept higher premiums or wait, except in a panic. People don't like waiting. That's how you get a premium spiral. But that's not the part that matters most. The part that matters is the two paths from here, and how to tell which one you're in before the crowd realizes it. First, I'm going to give you a simple two-scenario lens, because this keeps you sane when price starts trying to manipulate your emotions. Scenario 1 is the controlled pullback and retest. In this path, gold pulls back toward a prior breakout zone. Think low to mid 4,400s, maybe even a flush toward the low 4,300s, then stabilizes. Premiums cool slightly but don't collapse. Availability improves a bit, but lead times remain longer than normal. Spreads calm, the curve normalizes. That would be the market taking a breath without breaking the structural story. It's the kind of path that feels bearish in the moment because the screen turns red, but it's actually how trends stay healthy. Scenario 2 is the continuation squeeze with gap risk. In this path, the market doesn't give you a neat dip. Instead, it grinds higher into thin liquidity, premiums remain elevated or worsen, wholesalers keep rationing, and any dip gets bought fast because physical buyers are desperate for certainty. If gold pushes back through recent highs in the mid 4,500s and holds, the next upside air pocket is psychological and mechanical. Round numbers, risk limits, and the pain points where shorts have to cover. In a squeeze path, you can see violent intraday swings and you can see gaps in availability. Products that simply vanish. That is not a guarantee, and you should never treat it like one. But it is a recognizable pattern when the plumbing is stressed. Because if this one level breaks, the math changes. Now let's define confirmation and invalidation, because credibility lives here. Confirmation is not one candle. Confirmation is a cluster of signals that agree. If premiums stay stubbornly high, especially on common products, that's a confirmation of physical stress. If lead times extend rather than normalize, that's another. If spreads show persistent tightness in the nearby structure, that's another. If regional premiums, particularly in key consuming regions, remain elevated, that's another. If institutional flows into physically backed products accelerate or remain firm, that's another. And if during pullbacks the market refuses to collapse and quickly reclaims key zones, that's another. Invalidation is equally important. If premiums collapse back to normal quickly, availability returns, spreads normalize, and price breaks below the prior breakout zone and fails to reclaim it, the squeeze narrative weakens. Not forever, not as a grand thesis about gold, but as a near-term freeze thesis. Because markets can be bullish over years and still unwind stress over weeks, the goal is not to be dramatic. The goal is to be right about the mechanism on the time frame you're operating in. And that's where the real pressure starts, because volatility is the tool the market uses to transfer money from impatient hands to disciplined hands. Let's talk about the viewer psychology shield, because this is where most people lose even when their long-term thesis is correct. In a regime like this, you will be emotionally manipulated by three things: headlines, whipsaws, and social proof. The headline will be designed to sound final. Gold collapses, gold surges, buyers vanish, panic erupts. The whipsaw will be designed to punish your timing, sharp drops that feel like the end, sharp rallies that feel like you missed it. And social proof will be designed to make you doubt yourself, people yelling certainty on both sides, making it sound like only an idiot would disagree. Your defense is structure. Your defense is knowing what is signal and what is noise. Signal is a sustained break and hold of key levels with confirmation from premiums and spreads. Noise is an intraday spike that reverses. Signal is persistent tightness in the deliverable channels. Noise is a one-day dealer promo or a temporary website outage. Signal is a curve that behaves like the market is paying for immediacy. Noise is a single print that gets arbitraged away. And here's the most important psychological truth. Even if you're right, price can whip around violently. It can drop hard and still be in an uptrend. It can rip higher and still be vulnerable to a flush. That's not a contradiction. That's how markets clear positioning. The way you avoid panic decisions is by choosing a time horizon first, then choosing risk size that fits that horizon, then defining what would actually change your mind. Not what would scare you. What would change your mind? Short sentences again. Write it down. Respect it. Because if you don't, the market will write it for you. But that's not the part that matters most. The part that matters is what to watch next. Right now, this week, this month, so you're not trapped reacting to noise. Watch the premium behavior like a heartbeat monitor. If that $150 premium persists or spreads across more products, the stress is not done. Watch availability language. When the market goes from ships today to ships in 2 weeks, you're watching supply chain friction monetize itself. Watch spreads and the feel of liquidity. If the market starts jumping between quotes, if bids feel thin, if pullbacks get bought aggressively, that's not normal calm trading. That's pressure. Watch the way price behaves around recent structure. If gold holds above the low to mid $4,400 on pullbacks, that's constructive. If it loses that zone, slices down toward the low $4,300 and cannot reclaim, that's a warning that the market is delevering and the freeze story may cool. On the upside, if gold reclaims and holds above the mid 4500s area, you're stepping into a zone where reflexivity can kick in. Trend funds, systematic strategies, and hedging flows can all start leaning the same way. And when flows lean the same way, the move stops being about opinion and starts being about who has to do what. That's where the real pressure starts. Because a squeeze is not everyone suddenly believes. A squeeze is somebody can't hold the position under margin and liquidity constraints. It's forced buying, it's short covering, it's dealers hedging, it's inventory being rationed. It's a cascade of obligations, not a cascade of feelings. Now I'm going to address the skeptical angle directly, because you're right to be skeptical. The internet loves to scream manipulation every time a market does something confusing. Here's a more finance-literate framing that keeps you grounded. Incentives. In every market, different participants have different incentives. Some want stable prices, some want liquidity, some want volatility, some want to hedge, some want to speculate. When volatility rises, risk managers tighten. When risk managers tighten, dealers widen. When dealers widen, the physical market looks like it's freezing. That doesn't require a villain. It requires a balance sheet. It requires collateral. It requires a system designed to protect itself. And in a stressed moment, systems protect themselves first. That is why the wholesale channel can refuse to ship, even when there is metal in existence. They are refusing to take delivery risk at a price that doesn't compensate them for the collateral and logistics risk. The real price becomes spot plus premium. The market is telling you, if you want certainty, pay for it. But that's not the part that matters most. The part that matters is the quiet mismatch that causes retail panic to be louder than wholesale supply. Form factor. Big bars and institutional vaults are not the same as retail bars and coins. Converting one into the other takes time, refinery capacity, and logistics. During calm times, that conversion pipeline is smooth enough that few people notice it. During stress times, it becomes the bottleneck that makes plenty of gold exists compatible with I can get the product I want without paying $150 extra. That's not magic. That's manufacturing capacity and scheduling. Add shipping and insurance constraints. Add holiday and calendar effects. Add the way dealers manage inventory to avoid being trapped. And suddenly, the wholesale freeze looks less like a mystery and more like a predictable feature of a high volatility, high price environment. Now, let's do a quick reality check on risk, because this is where trust is earned. Nothing here is a promise. Gold can drop hard even if the long-term story is intact. A single policy headline, a sudden dollar spike, a rate shock, or a liquidation wave can smack the price down violently. That can happen even while physical remains tight, because paper markets can de-risk faster than physical markets can reprice. That's why you need the two-scenario lens. If you're in scenario 1, you respect the pullback and look for stabilization and confirmation. If you're in scenario 2, you respect the gap risk and you do not chase with money you can afford to see whip around. Either way, you're not married to a narrative. You're married to a mechanism. Trend signal versus noise, structural stress versus temporary hype. That's the line. And that's where the real pressure starts, because the market will try to make you confuse volatility with invalidation. Don't let it. Define your invalidation level based on structure, not fear. If your thesis is physical stress is tightening the market, then your invalidation isn't price went down today. Your invalidation is premiums normalized, availability returned, spreads calmed, and the market failed key structure and couldn't reclaim. That is a different standard. It's a better standard. Now, here's what I want you to take away as a near-term roadmap you can actually use. Over the next week or two, the most important question is not, will gold go up? The question is, does the physical stress persist into the next decision window? If it does, the market has to choose between rationing demand through price or unlocking supply through incentives. If premiums remain high and wholesalers remain cautious, price has a reason to stay bid even on pullbacks. If the stress fades, you can see a sharp mean reversion that feels like a betrayal but is actually just the system unclenching. Watch the calendar, watch the liquidity pockets, watch the way price behaves around those key zones, and most of all, watch the pressure gauge that doesn't care about opinions, premiums, and spreads. Because headlines can change overnight. The plumbing changes slower, and when the plumbing changes, it drags price with it. But that's not the part that matters most. The part that matters most is you not getting played by the volatility. If you're here because you're skeptical of institutions and tired of narratives, then act like it. Don't outsource your decisions to the loudest voice. Track mechanisms, track incentives, track stress signals. Be the person who can say calmly, this dip is noise, or this break changes the math based on structure. That's the difference between being early and being exit liquidity. And that is the quiet community I am building here. People who don't need certainty, they need clarity. If you want to be part of that, stay close to the checklist, keep your emotions out of the intraday drama, and share this with the one person you know who keeps getting chopped up by headlines. Because the next detail is what flips the whole setup. In markets like this, the winners are not the ones who predict perfectly. They're the ones who manage risk while the market is trying to hypnotize them. Two scenarios: clear confirmation, clear invalidation, premiums and spreads as your truth serum. And a simple rule: if the supply chain keeps vetoing the paper market, the repricing isn't done. Yet.